Welcome to our new episode. We have Taj Ahmad Eldridge from Include Ventures, with whom we will talk about what funds of funds are looking in entrepreneurs and venture fund deals. What does it mean to be impact driven, as well as what are the sectors you can focus on to succeed in the next 5 to 10 years. If that sounds interesting to you, click that like button, subscribe, and don't forget to click the bell in the YouTube video so you don't miss our notifications. We're bringing incredible fund managers, family offices, and successful entrepreneurs to talk to you about what are the key points to success in raising capital. My name is Anastasia Rivada, and let's jump right into it. Hi, Taj. So great to have you here with us.
Great, Anastasia. I'm glad to be here. Hello again.
I'm so glad you are one of the people who've been an inspiration for me within the LA community, within the venture LA community, and primarily investment community focused on impact. I know you have a lot of progress that happened since the last time we spoke. Last time we spoke, you've been a director within LACI, and now you have your own fund, and it's a fund of funds called Include Ventures. So why don't you tell us a little bit about your background, about Include Ventures, for our audience to understand you better?
Yeah, absolutely. Thank you so much for this opportunity and to talk about my team and our fund and what we're doing. So I'll start out with kind of how I got to this point and where we're at. So grew up in the South, grew up in Texas, and was in banking, commercial banking, and asset management with UBS. So I didn't really have a knowledge about the venture capital private equity industry until I ended up leaving and joining a startup company. And then within a startup company, that's when I started really kind of figuring out the ideas of venture capital and everything else. And I ended up going to the University of California as accelerator director, as well as LACI that you mentioned as a senior director, really kind of managing that piece of it. And then in the last year, my partners and I, we launched Include Venture Partners, which is a $250 million targeted fund of funds and direct investment vehicle. The idea is for us to invest in women and people of color that are fund managers in our fund, as well as investing in companies in the areas of cleantech, fintech, edtech, and health tech with our direct investment vehicle.
Sounds very exciting. First of all, it's a hot subject right now. You're even LinkedIn promoting your post for me. I always read from you about what's happening in the for Black founders, for Black fund managers, for women-led companies. Your website, if you go and you open includeventures.com, says that investing is about relationships and trust, and also about the deal flow. You are the person that connects capital of your LPs to fund managers and then to entrepreneurs. It's a lot of relationships to build. How do you go about it?
Yeah, I always say I have a PhD in just knowing people.
I love it.
You have to be inquisitive. I'm always asking more than talking. I think a lot of times when people think about investors, they get this idea of the person always giving sage advice and always talking. I think the best investors are the ones who are always listening. The times they talk is most likely a question to learn more. And so for me, just listen to people's stories and always meeting people. And even now in a scenario where we're all in our own, homes and offices and behind a screen, I think it's even more imperative to go out and meet. I was just talking to another colleague who we met initially on social media, and we ended up having a video call afterwards. And I enjoy that because you're having those connections to people, not just in one section, maybe for social media, but in person and online. So I think, our business, even though it's a financial business and I'm a banker, economist, asset manager by trade, at the end of the day, venture is about relationships. And the strongest investors not only have the knowledge of the sectors that they're in, but they have really great relationships and value relationships too, because it's more than just to being transactional. you have to provide value to the people you have relationships with.
It's a very valid point that I feel like a lot of people who are in business of fundraising are internally resisting. They just want to get a check and get going with their business. How do you select deals? How do you select people you invest in?
Yeah, good for that. You know, one of the things I tell the founders that I deal with, both as an advisor and as an investor, is that, you know, media has taught us that raising capital is celebratory, that you should just, you know, celebrate, I just raised this round. And I would tell our founders is that that's not a celebration, that's an obligation. You're obligated now to me as an investor. You're obligated to take that money I provided to you as an investor to make sure your team is going to have a job tomorrow. And you're obligated to ensure that your customers get your product, whether it's a service or a product. And so I think that that's one of the ways that founders should look at it. And I think more so now from an investor standpoint, you know, investors, in my opinion, some investors don't believe this, but I think investors should provide more than just a check. It should be some added value, because anybody can write a check, and there are a number of funds coming out there. Thankfully, we're a fund of funds, so we see it. But, you know, for me, when I talk to people and I talk about what I provide, I say I provide the 4 C's, which is access to capital, access to customers, access to connections, and access to customers. You need all 4 of those things to really survive. And when I mention access to culture, what I mean by that is access to a culture of good corporate hygiene, access to a culture of doing good, being ethical, because those things are important, because you can have things that are unethical in your company that will destroy it, no matter how much capital you raise, how many customers you have, and so forth and so on. And so all those 4 things are important: connections, customers, capital, and culture.
When you're looking at the fund manager that wants to raise capital from your fund of funds, how are you evaluating the fund manager? Is this more about the person? Is this more about the deal flow? What are the key criteria for you?
Yeah, and my apologies for going off on a tangent of the previous question. Evaluate the founders. 3 things for me: people, product, market. So that's the top thing. I think on the fund manager side, what I tend to look for is, just like I mentioned, what value add are you adding to your founders? How are you getting that deal flow? And because it's so competitive and there are a number of funds that are coming to market, how are you going to be differentiated in others? I think when you're and we invest in not only fund 1s or emerging fund managers, but fund 2s and fund 3s, but a glut of the funds are in fund 1s. And I tell people who are emerging fund managers of fund 1s, you have to make sure you differentiate yourself, and you have to do it more than just on thesis. You know, everybody thinks they have a really great thesis that no one else does. Has, and I can tell you that it's similar. So for me, it's about how can you as a fund manager provide services that are different than the other person, and then further, how can you be in a scenario where founders are going to want to join you and want you to be on that cap table. I say this all the time, that I remember there was a founder that just raised last year in Los Angeles, and she was oversubscribed by $8 million. So a number of funds with big name funds at that did not get into the round. And I was like, that's going to be the norm pretty soon. You're going to have really great competitive opportunities. And we need fund managers that are competitive.
How do you usually get approached by fund managers? What you mentioned, something that I believe is a key of building a relationship. You have to provide value. Yeah. If we're talking specifically about the fund manager, is there value primarily based on what value they're providing for their portfolio, or there is a value that they can provide for you as a fund as well?
Yeah, it's the value that they're providing for their portfolio, which in turn provides value for me, because it makes my return greater, and it makes them a very popular fund, and a fund that get into deals that make sense for them. I think how fund managers find, the good thing about it is that there are a lot of fund of funds like us. There are a few others. We're very public. We try to be out there. That's why I do a lot of panels, a lot of talks, a lot of podcasts like this to really talk about what we do. And a lot of time it's for us. It's for us to search and find the great fund managers, and really kind of the the fund managers that are underutilized and underrepresented for it as well. So I think similar to the funds, I would tell fund managers all the time, and I used to say this quote that you can't just sit in Sand Hill Row and expect for good deals to come to you. You have to get out the office and find those deals. And it's the same thing for us as a fund of funds. We can't just wait for fund managers to come and pop up at us. We have to always have an ear to the street and knowing who's out there, who's doing some really great work, who the founders enjoy and revere and get information from as well.
If you're talking to the first time emerging fund manager, and we have a lot of them in our portfolio, we talk to them a lot. And one of the biggest challenges they face is, how do you raise capital when you don't have a track record?
Yeah, good question. There's two things I will answer that. Number one, there's a document going around that's called Due Diligence 2.0 that was started by a young lady named Rachel Robascioti, who has a fund called Adesina Capital in the public market space. And it's basically telling LPs, limited partners, to think differently about traction and the way that we evaluate fund managers. We do it ourselves as well. When I was an advisor before I became an investor, I would advise a number of companies. And some of those companies, one of my first exits was a company that I advised. And so I think that for fund managers, there's great opportunity for people to go into deals, whether it's through crowdfunding, equity crowdfunding with Republic, whether it's through SPVs like Cap Table Coalition here in Los Angeles, whether it's through many different ways, or advising. The key to that is showing that you can pick great founders and great companies, and this is the way that you pick them. So even if you're a fund manager and you don't have a really strong track record, you haven't invested before, but you can show the limited partners that, look, these are the companies I advised. These are the companies that I put a small amount of capital to. These are the companies I provided access. I was a scout or what have you. I think those are just as important as investing in your own, and that can show your ability to get good deal flow and to pick great companies.
That's a great advice. Thank you so much for sharing it. When it comes to, I want to talk with you about impact a little bit. I would say you're one of the people that's been there before it was cool. Yeah. And I think right now there is this tension in the investment community where you kind of have to have impact strategy. You have to have ESG strategy. And at the same time, people are, when you're talking as a fund to your LPs, you want to be opportunistic. So it's almost like an internal conflict. Are we purely impact driven? How can we integrate that as our DNA, which I think you've been successful in doing? Yeah. Versus, we're opportunistic, but we still want to do some good. Which trajectory would you suggest and how to navigate it?
Yeah, well, first, I think for me, when I first came into the business, I didn't realize that impact investing was this whole separate piece of it, and they kind of put in their own little corner. For me, every investment that we make has an impact. I don't care if you make an investment in Spotify. I don't care if you make an investment in a clean tech company. I don't care if you make an investment in Facebook. It will impact communities. It will impact people. It will impact health. It will impact this world. So that's the first and foremost thing, is that every investment we make is going to have an impact. We have to just decide if we're going to, call it out or not call it out. I think now you have a lot more fund managers making investments, and they're realizing that job creation is a huge impact. And that's something that we're seeing a lot more people study and track. We're seeing that sustainability, clean tech is finally back in the good graces of people are really interested in it. Clean tech is no longer a dirty word. So the sustainability of the investment and how the companies go from a sustainability standpoint is something that we're seeing tracking. And then, of course, you mentioned earlier DEI, diversity, whether race and gender, and hopefully also geographic diversity, where you're really investing in companies that are in areas that might be opportunity zones or LMIs. I think those are being tracked as well. So for me, employment, diversity, geography, sustainability are four areas that I think are kind of moving forward in the impact space. And you can still be opportunistic there. You can be opportunistic and really have some great and invest in great companies. But I think there's being some opportunities to track on that end. And I think it's different. I mean, I think if you ask the average impact investor, they would say that it's not far enough. But I think that that's the start where we're going to see a lot of the traditional investments going towards.
if you could share, when it came down to your fundraising for your fund right now for Include Ventures, what was the strategy that you chose to communicate your difference outside of anybody else on the market?
Yeah, I think for us, there was a power in empowering the people. As I mentioned with founders, people, product, market, and I led with people for a reason. So there's three of us as partners, and the three of us have really different outlooks, but similarities in what we want to do and accomplish. One of the partners is a former investment manager with CalPERS, managed $550 million worth of fund. So he has that experience in really selecting great fund managers. One other partner is Bahia Robinson, our lead partner, is an ecosystem builder, building VC Include, which is a training program. So she really has experience on that end as we go into other markets. And myself, I've spent the last 25 plus years as an investor and advisor for companies in the cleantech space, the mobile space, the fintech space. So I think for us, the idea that we knew, we were in the space that no one was in, we were not in the seed stage space. We kind of knew that the A round space and B round, the later stage, are needed when we start talking about diversity. And then also too, we looked at diversity different than others. A lot of people just think about diversity as with race and gender, but we think about diversity as geographic diversity. Me growing up in Texas really influenced that. And I think once you start getting out of California, specifically San Francisco and Los Angeles, once you start getting out of New York, you start getting into these smaller cities in the South and the Midwest, you're going to have some diversity there. And it might not only be gender and racial diversity, but it also will be economic diversity because they'll be able to create great jobs. You have great talent.
This is such a valuable point you mentioned on diversity. And I also, because, we're both in California, and there is this bubble that I feel like it's bursting since there are more and more funds being opened outside of the US. And there is just Founders Institute chose a direction to grow their VC lab and educating fund managers from literally all over the world in opening funds. So becoming a venture fund manager is becoming more accessible. How do you think it will affect the ecosystem as a whole?
Yeah, I think, one of the things, the reality of it is I think there's going to be a lot of, there's a lot of capital. I mean, there was just a note on PitchBook that says that we have a glut of seed stage funds that are out there. I think there's going to be some failures because you're going to have a lot of competition and competitiveness where fund managers are going to try to find, the jewel that nobody else is looking for. But I think also what I'm excited about is that there are, Sequoia just came out with the way they're looking at funds, and they're totally different. And I think what I'm excited about is it's funding the next generation of firms that are different than what we see now. I think the 2020 model is great, but it might not be effective to manage a lot of the capital that's out there. And so I think we're going to see a lot of new things, whether it's venture studios, which I'm really bullish on, and I think venture studios provide a lot of great value, to venture holding companies, which are a little bit different as well. I think all of those things are going to really impact our industry finally, because we've always told founders we want them to disrupt their industry, but when was the last time the venture capital industry itself has been disrupted? And I think that's something that we're seeing as well.
Yeah, so it sounds like you're saying that there will be a lot of change in the structure of how funds operate, and maybe the typical 220 is really not the future. Is there any instrument, you mentioned venture studio, venture holding, is there any unique instruments that you see that you can share with our audience for the fund managers that they might be able to apply to their structure?
Yeah, no, one of the things I see that's been pretty exciting, and I kind of mentioned it earlier with Cap Table Coalition, I've been seeing a lot of SPVs being created, special purpose vehicles. I think those are really interesting to get capital to founders that may go a different way and find some other things as well. Republic, I've mentioned before, but I've been seeing new equity crowdfunding sites pop up that are with affinity groups, one of which is with a fraternity that I'm a member of, that they just recently launched to provide capital and liquidity to companies in this space as well. I think those are two of the most exciting scenarios, these new approach on equity crowdfunding, as well as SPVs. Another thing that's going to be coming down the pipeline, the audience might be aware of, there's a as a group or organization called SBICs affiliated with the federal government, with the Small Business Administration. There's a possibility that the rules on our SBICs might change, which will allow venture funds to take on additional capital from the federal government through the SBA, especially if they're focusing on companies and that are in areas, like I mentioned, that are outside of the path of traditional venture. And so I think those are the things that we're going to start seeing a lot more of. We're going to see a lot more of the public-private partnerships. In addition to that, historically, a lot of the incubators and accelerators really focused on public-private partnerships. But I anticipate seeing a lot more funds really kind of get into that space and be a hybrid of a fund / a venture studio / an accelerator.
I feel like there is so much knowledge and insight that can be pulling out from you, and it will take a very long time to our audience that is listening to you. I want to suggest, and as a must-have, is to go and follow Taj on LinkedIn. We will post the link under this interview because he is sharing a ton of wisdom and insights and news. One of the first people that is sharing it on the market, and it's always fresh and amazing. Taj, I want to wrap up with a piece of wisdom from you. What was the best advice in your career? You have a stellar track record. Yeah. You are an inspiration to many, including me. Was there somebody, or was there a phrase or an advice that really stirred your path?
Yeah, good question. I think for me, there was a gentleman by the name of Reginald F. Lewis, who was the CEO of a company called Beatrice back in the early 80s, late 90s. And he was the first guy that I heard about venture capital. Before then, I didn't really care about the financial markets. I know about the investment arena, but not too much about venture capital and private equity. And he passed away before I could meet him. He had a brain tumor. But that experience and reading about him really influenced me to move forward and go into this industry. I say that to say that sometimes our influences and our mentors can be in person, but they can also be somebody who's not here before or anymore. And I think that, venture capital is not the end all be all. There are many different ways to really make innovation. And one of the things I always tell people is that I was lucky enough to not only be a VC, but I was also a founder. I was also in an accelerator. I was also in a university accelerator. So I say all that to say that VC is not the end all be all. There are many other opportunities and pathways to really help push innovation in this country. And I love to get people to think about that, because I think the universities need people with a strong business background to be in the space to move the data forward, who are not academics. The accelerators need really fresh talent. And there's a lot of founders who are about to get funding. They need co-founders, and they need a lot of talent on that end as well as team members or even advisors. So, I think there's a phrase that I've heard often, and I use it myself when I talk to people, and that is find a way or make one. So, if the way is not there, you should find it. If you can't find it, make it. And I think that's how we should approach everything as people trying to get into this business.
Beautiful. It gave me goosebumps. I think it's a very, very powerful quote. Thank you for sharing.
Yeah.
I appreciate having you here. I hope we will be at least once a year bringing you to this talk and to share insights on your side. I'm sure a year from now, you will be even more successful, creating even more impact and empowering even more entrepreneurs and funds.
Yeah, thank you so much, Anastasia. Like for me, again, success means that for me, that the next year that you're doing this podcast, that there will be 10 fund managers that we funded on it, talk to you about their success. And so for me, it's that, that's what I want to see. And I think, for the audience, listening to a podcast like this are important. This podcast is reminiscent of the book that I read that got me into venture capital by Reginald F. Lewis. So know that you're probably influencing somebody else, the new me, years from now, who will listen to this podcast, and you and the people that you're interviewing to get into this space. So thank you for building this.
It's my true pleasure. Let's bring more people into innovation.
Yeah, absolutely.